Welcome to Thoughts on the Market. I'm Andrew Sheets, Head of Corporate Credit Research at Morgan Stanley.
And I'm Kelvin, Head of Asia Credit Strategy.
And today in the program, we're going to finish our global tour of credit markets with a discussion of Asia. It's Friday, June 20th at 2 p.m. in London.
At 9 p.m. in Hong Kong.
Kelvin, thank you for joining us. Thank you especially for joining us so late in your day to complete this credit world tour. And before we get into the Asia credit market, I think it would just be helpful to frame at a very high level how you see the economic picture in the region.
We do think that the talks and potential deals will probably provide some reprieve towards the growth for the region, but not a big relief. We do think that tariff uncertainty will linger here and it will keep growth sort of low here, especially if we do think that capex of the region will be weaker due to tariff uncertainty. A weaker US dollar, for example, plus monetary easing will help offset some of this growth drag. But overall, we do think that the Asia region could see 90 basis points down in real GDP growth from last year.
So we've got weaker growth in Asia as a function of high tariffs and high tariff uncertainty that can't be offset by further policy easing. In the context of that weaker growth backdrop, higher uncertainty, are credit spreads in the region wide?
No, they're actually really low. They're probably at like the lowest since we start having data in 2013. So definitely like a 12 to 13 year low of the range.
And so why is that? Why do you have this kind of seemingly odd disconnect between some real growth challenges and, as you just mentioned, really some of the tightest credit spreads, some of the lowest risk premiums that we've seen in quite some time?
Yeah, we get this question a lot from clients. And the short answer is that, the technicals, right? Because the last 3 years, we've been seeing negative net supply for Asia credit. A lot of that is driven by China credit. And if you look at year to date, supply remain still negative net supply. And demand side, for example, has not really picked up that strongly, but it's still offset. Any outflows that we see the last 2-3 years is offset by this negative net supply. So you put these two together, we have this very strong technicals that support very tight spread. And that's why spread has been tight at historical end in the last, I would say, 1 to 2 years.
Do you think this changes?
Yeah, we do think it's changed. We have a framework that we call the normalization of Asia credit technicals. And for that to change, essentially our framework is saying that treasury yields need to go down and dollar funding need to go down. Cheaper dollar funding will bring back issuers, net supply should pick up, demand for credit tends to do well in a rate cut cycle, demand tend to pick up in a rate cut cycle. So if we have this two support, we do think that Asia credit technicals will normalize. It's just that, we have 4 stages of normalization. Unfortunately, we are in stage 2 now, and we still have a bit of room to see some further normalization, especially if we don't get rate cuts.
Got it. So, we do think that if Morgan Stanley's yield forecasts are correct, yields are going to fall. Issuers will look at those lower yields as more attractive. They'll issue more paper in Asia, and that will kind of help rebalance the market some, but we're just not quite there yet.
Yeah, we feel like this road to rate cuts has been delayed a few times in the last 2-3 years, and that has really been a big conundrum for a lot of Asia credit investors. So hopefully, third time's the charm, right? So next year's a big year.
So I guess while we're waiting for that, you also have this dynamic where for companies in Asia, or I guess for any company in the world, borrowing money locally in Asia is quite cheap. You have very low yields in China. You have very low local yields in Japan. How do those yields compare with the economics of borrowing in dollars? And what do you think that kind of means for your market?
Yeah, I think the short answer is that we are going to see more foreign issuers in local currency market. And, we wrote a report in March just to pick on the dim sum corporate bond market. It benefits.
And Kelvin, just to stop you there, could you just describe to the listener what a dim sum bond is and probably why you don't want to eat it?
Yes, so dim sum bond is basically a bond denominated in CNH. So CNH is an offshore Chinese renminbi sort of proxy. And it's called dim sum because it's like the most local cuisine in Hong Kong. A lot of dim sum bonds are issued in Hong Kong. A lot of these CNH bonds are issued in Hong Kong, and that's why it's have this sort of nickname called dim sum.
So what is the outlook for that market and kind of the economics for issuers who might be interested in it?
Yeah, we think it's a great place for global issuers who have natural demand for renminbi or CNH to issue 10-year CGB. Now is like 1.5, 1.6%. That makes it a very attractive yield. And for a lot of these multinationals, they have natural renminbi needs, so they don't need to worry about the hedging part of it. And for a lot of investor base, the demand are picking up because we are seeing that renminbi internationalization are making some progress. Higher progress in that means better demand. So overall, we do think that there is a good chance that the renminbi market or the dim sum market can be a bit more global player or global sort of friendly market for investors.
Kelvin, another sector I wanted to ask you about was the China property sector. This was a sector that generated significant headlines over the last several years. It's faced significant credit challenges. It's very large, even by global standards. What's the latest on how China property credit is doing, and how does that influence your overall view?
It's been 4+ years since the first default started, and we went through like 44 China property defaults, close to about 127 billion of total dollar bonds that defaulted. So we are close to the end of the default cycle. Unfortunately, the end of default cycle doesn't mean that we are in the recovery phase or we are in the speedy recovery phase. We are seeing a lot of companies struggling to come out of restructuring. There are companies that come out of restructuring and re-enter defaults. So we do think that is a long way to go for a lot of these property developers to come out of restructuring and to get back to a sort of going concern kind of status. I think we are still a bit far. We need to see the recovery in the physical property markets. And for that to happen, we do need to see the China economy to pick up, which give confidence to the home buyers in that sense.
So, Kelvin, we started this conversation with this kind of odd disconnect that kind of defines your market. You have a region that has some of the most significant growth risks from tariffs, some of the highest tariff exposure, and yet also has some of the lowest credit risk premiums with these quite tight spreads. If you look more broadly, are there any other kind of disconnects in your market that you think investors around the world should be aware of?
Yeah, we do think that investors need to take advantage of the disconnect because what we have now is a very compressed spread, and we like to be in high quality, right? Whether it's switching out of Asia high yield into Asia investment grade, whether it's switching out of triple B credit into single A credit, we think investors don't lose a lot of spread by doing that, but they manage to pick out a higher quality credit. At the same time, we do think that one thing unique about Asia credit is that we have significant exposure to tariff risk. Asia countries are one of the few that are, 7 out of 10 countries that are having trade surplus with the US. And that's why we think that the iTraxx Asia ex-Japan CDS index could be a good way to get exposure to tariff uncertainty. The index did very well during the Liberation Day sell-off. Now it's trading back to more like normal level of 70, 75 basis point. We do think that for investors who want long tariff risk, that could be a good way to add risk.
Kelvin, it's been great talking to you. Thanks for taking the time to talk.
Thank you, Andrew.
And thank you, listeners, as always, for your time. If you find Thoughts of the Market useful, let us know by leaving a review wherever you listen. And also tell a friend or colleague about us today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.